Hello and welcome to Accounting Vision. In this topic, we're going to learn break-even analysis. The main goals for this video is to understand what it is, understand the formulas and how to use them, and by understanding the formulas, you're going to be able to answer common questions. And these common questions can be illustrated using diagrams, and we are going to talk about the advantages and disadvantages. So let's start by looking at what break-even analysis is. Break-even analysis is an analysis that is used to help us understand where the point lies where the total sales equals total costs. We can illustrate this using a diagram where we have sales on this side and cost on that side. If sales is more heavier than the cost, it will give us a profit. If cost is more heavier than the sales, it will give us a loss. But because both sides are equally weighed, it will give us no profit nor loss. We can illustrate this further using formulas. Formulas such as contribution per unit is calculated using selling price and variable costs. Contribution is basically the amount that is needed to cover your fixed costs in order to make profit. We can use this as an example where let's say we sell an iPhone for £100 and it has a variable cost of £50. Sales minus variable cost will give us £50 of contribution per unit. And let's say we've got a fixed cost of £30. The contribution per unit does cover fixed costs and therefore gives us a profit of £20. Another example of a formula will be break-even point where we use fixed cost and contribution per unit. And then finally, another formula is margin of safety, and that is calculated using actual units and the break-even units of output. We can illustrate this further using an example question. Let's say a business sells a product for £5 and that's a selling price, and they have a variable cost of £3. They also have a fixed cost of £10,000 and they have sold 10,000 units, and that units is the actual amount that they have sold. We're going to use this to illustrate this through a diagram. So here is an example of a break-even chart. Here in the bottom axis we have a quantity measured in thousands and the top axis measured as money in thousands. The green line represents revenue, the red line represents fixed cost, and the blue line represents total cost. You may ask yourself, where is variable cost? Well, variable cost is located here, and the reason why is that fixed cost plus the variable cost will give us the total cost here, which is that line that represents the fixed cost and variable cost. So you may get questions asking you to calculate contribution per unit, break-even output, and margin of safety. But don't worry, we're gonna break this down. So first, let's start answering this question here. Contribution per unit is calculated using selling price and variable cost. So here we have £5 of selling price and variable cost of £3. So all you need to do is 5 minus 3, and that's going to give us contribution per unit of £2. Next, we're going to calculate break-even output. So break-even point or output is located in this point here where the revenue and total cost intersects. So basically, the formula is fixed cost and contribution per unit. So we know that fixed cost is £10,000. It's also written here. So we're going to write £10,000, divide that by the contribution per unit, which we have calculated, which is £2. And that's going to give us in units 5,000 units of break-even output. So that's going to be located here. So we're going to write that down here to visually explain what happens. So if anything is above, in terms of units, is above 5,000 units, then that's going to give us profit. And anything below 5,000 units will give us a loss. So because the business has sold 10,000 units, they have made a profit because this is more than a break-even uh, output in terms of units. So now we're going to have to calculate margin of safety. Margin of safety is basically the difference between the actual units and the break-even point. So we're going to have to calculate that. So 10,000 units is the actual units minus the 5,000 units, which is a break-even point, and that's going to give us 5,000 units of margin of safety. You may also come across questions where the break-even point changes, maybe due to costs or other circumstances, but in this case it could be costs. Why? Because of step fixed costs. and I do explain that in my previous videos, talking about different types of cost. If you want to look at that, I suggest having a look at it after watching this, as it will be useful for you to understand. But anyways, going back to this, um, we're going to have to calculate contribution per unit. So contribution per unit still stays the same. So we're going to have selling price of £5 and variable cost of £3. So all we need to do is 5 minus 3. It's going to give us £2 of contribution per unit. The next two questions where things differ, as the fixed cost has now gone up to £25,000. Previously it was £10,000, but now it's gone up to £25,000 due to stepped fixed costs. So we're going to have to write £25,000, divide that by the £2 of contribution per unit, and that's going to give us in units 12,500 units of break-even point. So that's going to be located here. So you can see that visually that the business has made a loss because they've only sold 10,000 units, which is less than the break-even output, and they're going to make a loss basically. So now we're going to have to calculate the margin of safety. So margin of safety is the difference between the actual units and the break-even point. So we're going to have to do 12,500 minus 10,000 units equals 2,500 units of margin of safety. I hope that was easy to understand, hopefully. And now we're going to talk about the advantages and disadvantages. An advantage of break-even analysis is it helps us to plan the amount of units to make profit, which will help us to make relevant decisions, and it will help us to analyze how risky a project is in terms of the break-even point. However, break-even analysis does also have limitations. One limitation is that they are estimates, as the figures you see in the diagram may not be guaranteed to be the same due to costs changing, and these costs can be like fixed costs, as I've shown you in a previous slide that they could go up due to stepped fixed costs, and it does not take into account any external factors such as technology, which may impact on the business's performance. Just to summarize this video, contribution must cover fixed costs. It is calculated using sales and variable costs. Margin of safety is calculated using actual units and break-even units. If the actual units is less than the break-even output, it will give us a loss, whereas if it's greater than the break-even output, it will give us a profit. And it does have advantages and disadvantages. If you found this video useful, please give it a like and do share it to others, as I will be posting more videos in an easy and understandable way for you to pass your accounting exam. If this is something you're interested in, then be sure to subscribe, and thank you for watching this video.